And there we go. We are live on the interwebs for now.
For now.
Ryan Ray alongside the good doctor herself, Dr. Ellen Wald. Miss Wald, it is Monday, January 11th. And let me tell you something. The oil prices are looking at me and they are laughing at me and slapping me around as they are above, 52? Last time I checked, it's just a crying shame.
Oh
So
yeah.
I have no basis for making oil price predictions ever again.
Well, did you hear what Goldman Sachs is now forecasting? Which actually I picked as our new first article. I hope I told you that. Maybe I didn't tell you that. But yeah, Yahoo Sports, by the way. Yahoo Sports is reporting that Goldman expects Brent oil prices to reach $65 per barrel in summer of 2021.
65.
Yeah, 65 this summer, June. It is coming. Prepare yourself.
Now, didn't Goldman come out the other day and say that we might have a little bit of inflation this year? Was that them as well? Or
Probably.
no, what was it? The tweet you commented on it, something about the stock market was a little bit unstable. What
Oh
was
yeah. It might
it?
be there might be a little bit of a bubble.
A little bit of a bubble. 65? Wow. Oh, I did not see
Yeah.
that. That's
Oh yeah. Here. I saw that today. Here, I'm posting it on our feed.
yeah. So yeah, there it is. I pulled it up. Okay. Yeah, Goldman Sachs.
My favorite part about it is that this is a Reuters article, but Yahoo is posting it in its sports section.
For all the bettors out there. Oh, hey,
Yeah.
Doug Peterson is fired as Eagles coach. A little breaking news brought to you by Yahoo
Oh.
Sports. That's the benefit of having sports and the oil mixed together. So you've had a week now to kind of digest the Saudi stuff. We didn't get to talk much offline. I know we had exchanged a few messages, but didn't really talk about it much. What's your take on the Saudi cut now that it's been not quite a week, but a week after?
It's like, I mean, it's been a gift basically because it helped buoy oil prices even more than this vaccine news, despite the fact that the vaccine rollout seems like it's an utter failure in a good number of places. I don't think that it's a failure in every place. Israel's doing really well.
Yeah.
Florida is not bad. Like
Mhm.
it's definitely going on in Florida. But like some places it seems like a complete mess up. And so but I think that this Saudi surprise really did help buoy markets. And they raised their OSPs to Asia.
Yeah.
So did Kuwait, I think, and UAE and Iraq. They all raised it. But I think the question though is, will Iran, Libya, etc., be inspired to put more oil on the market? Are Asian buyers going to look to perhaps cheaper oil from the U.S.? And that, if the market is actually functioning and looking at like what's actually happening, that could kind of help range bound oil. So I'm not like, I mean, will we get to 65 by the summer? We could. Like, who knows at this point? I don't really love predictions, but I do think that, I mean, I think it could be a stretch in terms of demand, but one of the things that the Saudi surprise is supposed to do is destock.
Mm.
This is like the week of everything. We're deplatforming, we're destocking, we're debanking. So like if there is some real destocking, unless China comes through and starts adding barrels from its massive storage, the 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 actual supply demand picture could indicate that prices should be headed in that direction. Whether that's what the market wants to do is another story.
So help me understand this. This is kind of how I read the news. This is simplifying it, I know, for some of our trader commodity types out there. But, if McDonald's were to say that, hey, we're going to produce 1 million less cheeseburgers in February or March, you would want to know, is McDonald's not producing them because they can't, because they don't have the meat, the supplies, whatever, that, some kind of shortage, or they didn't expect there to be that many burgers sold. And so they're thinking, hey, we're taking this off. I read it as, the Saudis, there's no reason they can't produce. So my reaction was they're expecting the demand to drop substantially. And the Russians didn't have that opinion, right?
Well, I think, yeah, I mean, I think that was definitely clear going into the meeting. I mean, OPEC was coming out with all these statements saying demand looks really weak. By the
Mhm,
way, demand looks really weak for the rest of this quarter. It could be really bad.
mhm,
And even when, and Russia is like, we want to increase, we want to increase. So what they end up doing was giving in to the Russian increase, which actually is fairly small. They basically said like Russia and Kazakhstan would get to increase what their share of a 500,000 barrel per day increase would have been if they agreed to the whole 500,000 barrel per day increase for the group. So it's like it basically translates to like 65,000 barrels a day,
mhm.
which is not that much. And then they were like, well, Russia said they need it for domestic use because winter and it's cold, which is like kind of a lame excuse, right? I don't know how to buy that. But then you have Saudi Arabia coming in. Now, remember, Saudi Arabia also has a lot stored.
Mhm.
So Aramco is not going to, like, if someone comes to Aramco and says, we want to buy oil, Aramco is not going to say no. They're going to draw from storage. So I don't think we'll see exports going down at
Okay.
all. I really don't think that's possible. I just think that given the fact that they've raised their prices, people are going to look elsewhere.
Okay. So some people have speculated that this will lead to the drilling revolution 2.0 or 4.0, whatever it is, in West Texas. I know some.
Can you hear the drills? Have you heard them yet?
Yeah, they're lined up on the streets. So if there is a big ramp up in production in West Texas, so this is only through March, right?
Yeah, this is through March.
Okay, so through March. And so my understanding is the Chinese buying from I won't say the gentleman's name because he didn't say it, but he told me an analyst talked the other day said that China's basically done buying through March, and so they could pick back up in April or whatever, but they've already set their orders and they're done. If the U.S. comes out and they do, there's plenty of companies who have hedged and they start drilling and they drill the price down, which is what we've seen from 16 to up until last year before the COVID stuff. If they drill the price down and the price stays soft the rest of the year, because that could enrage the Saudis, could piss off the Russians, the price becomes soft. Um, it could be actually more long-term damage to the U.S. producers if the price goes the opposite way of what Goldman Sachs is.
Yeah, and it's interesting because right after this happened, we saw a bunch of shale people come, and they were asked about this. I think Occidental and Scott Sheffield was
Yeah.
talking about it. And I think most of what everyone was saying was basically like, this is not changing our strategic plans
Mhm.
going forward. Of course, that's what they say. And I think that I think it was Sheffield who said this, and it really struck me. He said this doesn't do anything to help to deal with the big factor, which is the cost of
Mhm.
services,
Mhm.
which is service costs.
Mhm. Well, service
But I'm
is
wondering,
always like that too, though.
well, exactly. I'm wondering if that's he didn't say that as like we're not producing more because service costs are too high. Is like this is not what we're doing, or he said that as like, hey guys, service companies, hit me with your best offers. Like that's basically like saying he's saying service costs are too high for us to drill more. Is basically saying, well, if service costs were lower, we would hire you and we would drill more. So like lower your prices, guys. And that strikes me as very realistic, given I remember looking at some stuff a couple years ago and seeing that like service costs are really a limiting factor here. That was really a big deal, and service costs would rise as oil prices rose and go down as oil prices went down. So it
Mhm.
seems to me that he's really just saying, I'm looking for a deal. But
I
if he
don't
wants
know.
to come on and talk to us
Yeah,
about it,
be happy to
please, Scott
get
Sheffield, we'd love to have you.
be happy to. I don't know. I mean, it would seem that if service prices aren't at the bottom now, when will they ever be? Because
Yeah.
you've literally starved people for 6 to 8 months, across the industry. So I don't know where they're at compared to what they
Yeah.
were 4 years ago, but they've got to be low. So let me ask you this: if we don't see a tremendous bounce back in, the ducks, I think the ducks is where you start at, right? Because they're cheaper to turn on, they're easy to turn on. So if we don't see the ducks turned on and we don't see production go up, by the time we get to summer, and U.S. production stays relatively flat, it's going to go up some regardless, I think. But it doesn't go crazy. Um, how do you think the Russians and the Saudis will interpret that? Do you think they'll interpret that as, hey, maybe the U.S. is someone that we can depend on not to go drill it down every time it goes back up? Or do you think they're going to just continue to kind of push their agenda, regardless of what the U.S. does? I guess maybe ask, is there, does it matter what the U.S. does as far as how the Saudis and Russians will respond moving forward, or not?
Yeah, that's a really good question. I think it does matter because I think that particularly since they've moved to this month to month thing, they're reacting. And they're looking very closely at any reaction. So I do think they're looking closely to see how the U.S. oil market responds. I think they recognize, what they should recognize at least, that there are more factors that are affecting it than just price, because like you've got, there could potentially be new regulations, new legal issues coming up. You have like there's a lot that could also affect production other than price, but price is pretty important. I think if you see a U.S. oil not responding in a significant way, that I wouldn't be surprised if that could kill the deal altogether, because what's holding Saudi Arabia and Russia together here? Because Saudi Arabia and Russia are the deal. Like they are the heart of this deal. And if they no longer feel like they need their combined forces to deal with market ups and downs and whatnot, then that could by removing that kind of outside threat. I don't think that it's about killing shale. I've never thought it's about killing shale. But if you remove that as kind of a threat, if there's no threat, like, hey, look, U.S. production stuck at like 10, 11 million barrels a day, and that's it. It's not going anywhere. That's where it's stuck at. They're going to look at that and say, well, do we really need each other? Is this Catholic marriage maybe looking for a little Protestant divorce? Sorry, it was kind of in bad taste, I guess. But they're the ones who call it a Catholic marriage, so
as a Protestant,
not me.
It's okay. Well, I will allow it as a Protestant on the show. So there we go. I can't for the Catholics. We don't have your representative. We are sorry.
Anyway,
but,
I would be wary. I think that is a risk. That if U.S. production doesn't show its hand here, doesn't show itself as a force, then there could be a risk to this integrity of this deal.
Yeah, and the destabilization would mean that you could have Russia, particularly, trying to then put the prices low to put the squeeze on the U.S. Right?
Yeah, even more so. But Russia could say, hey, look, U.S. production is stuck. It's not going. It's stuck in this range, and so we're just going to live with that.
Mm-hmm.
And then they're like, if Saudi Arabia wants to cut itself to oblivion, then let it. But we're going to live with that. We're going to live with 50 something oil. We're happy.
Right. That's true.
Could
Okay.
be.
Yeah, and so it's kind of odd now because look at the calendar here. If they're meeting on the 4th again, which I don't know if it's on the Monday or the 4th or how they're determining that. You're just a little bit over 1, 2, 3, 2.5 weeks away.
Well, I think they're skipping. I don't think they're doing I don't know if they're actually meeting in February. I think they may have decided to that this is like a 2-month thing. So OPEC agrees to meet every month, and at its first monthly meeting decides to wait to do 2 months.
Okay, I missed that. No, sorry.
There was a lot going on that day.
Okay, yeah. Well, I don't know if our listeners have been paying attention to the news, but there's been a lot going on in the news.
Ever, always.
Yeah, always.
I mean, in big, OPEC news, the Saudi oil minister did agree to include a vegetarian option at his big Saudi barbecue that apparently he's going to host for all the loyal OPEC followers, analysts, reporters. So some people consider that major news.
I saw you tweet about that. I thought you were just joking. You're being serious.
Oh yeah, he actually. Well, so he was joking about it because they had the Russians over for this. I think they call it Mandi, and the first reporter to ask a question was Anjali from Financial Times, and he said something about he's like, "You're still invited to the Mandi," and she's like, "Oh, well, I'm a vegetarian," and he's like, "Oh, there'll be a vegetarian option." So,
okay.
Breaking news: there will be a vegetarian option.
Vegetarian option. Okay. Let's see here, Ms. Wald. Let's go down to anything else on the OPEC that we wanted to hit on that I've not thought of that you wanted to.
I think we're OPEC'd out here.
OPEC'd out. Okay.
We've covered OPEC.
Our once a week OPEC is over. Okay. Now let's go to Dr. Ellen Wald. Here we go with Barron's. Ms. Wald, I will just let you tee this up yourself. Because
yeah, sure.
you are the author of this. Now, I will just say this. I am a little bit offended they didn't put the doctor on your name there. So
yeah, they never do. So yeah, that's okay. So little explanation about that. so it's like the policy apparently of Wall Street Journal and New York Times that unless you're like a medical doctor, they don't include doctor in your title.
Mm.
Although a friend of mine did get doctor included in his title of a piece he wrote about had to do with higher education. He's a professor of political science at Sarah Lawrence, and he got doctor in his name. So I actually like went and inquired. I was like, how come he got it and I didn't? They were like, well, he shouldn't have because that's
I've
our
got a
style
Wall
guide.
Street Journal
So it's a
story.
style guide.
Yeah. I've
No
got
hard
a
feelings.
Wall Street Journal story for you offline. I need to tell you about that happened this weekend. But go ahead. Sorry.
Okay, so this is in Barron's, and basically, writing about there's a regulation that the comment period just closed, which is basically saying that it's kind of complicated, but essentially the point is that banks cannot either revoke or refuse to offer financial services to entire industries just because of their industry. That they have to do like an actual risk assessment per client. They can't just say, oh, you're in this industry. Sorry, it's too risky. We don't offer services to anybody in this industry.
Mhm.
And that has been brought up by the fact that there have been a lot of activists who've been like basically pushing banks to debank people. I don't know if that's a real term or I made it up or something, but it seems like it fits in our deplatforming era. Various industries because they don't like them, like gun manufacturers, private prisons is a big one, companies that invest in drilling oil in the Arctic. So it's one thing you hear about people they're saying, we're not going to give loans to people who want to drill in the Arctic. So that's but they've also been trying to debank these institutions. And so it's one thing to so basically this regulation is saying like you can't say that for ideological reasons or for this like nebulous idea that banks say that it's like providing anything to this industry will cause a risk to this. It's kind of this nebulous, I forget the actual risk, but some sort of like vague risk to the bank. They're saying, you actually have to go and you have to do the risk analysis and you have to show why financially, like you can't deny it just because of this. If you're going to deny it, you have to do the financial risk analysis and you have to do it on a customer basis. You can't just say blanket industry, we're not going to serve you. As long as it's a legal industry.
Yeah.
And to me, that seems like a regulation that is in everyone's favor. Like if everyone should want this because you know what? If they do it to your like the industries that you don't like today, that means they're just going to go do it to the industries that you do like, next year. So and they do it and it's happened to not just to oil companies and gun manufacturers and private prisons, but it's also happened to abortion clinics. So it's not like a partisan issue. To me, it seems like banks are highly regulated industries anyway, and that this is basically saying you shouldn't be making moral decisions about issues that are about legal businesses in the United States. If you want to deny it for a financial reason, you got to do that and show it.
So the problem I have is not with what you're saying in principle. It's that I think there's a couple things here. One, and I was going to put this out last week, and I got other news came up. I was working on a piece about J.P. Morgan Chase trying to tie a deal with China, and I can't remember what the Chinese institution was, but they're essentially wanting to access China's financial market. And the same thing struck me ironic here as it did when J.P. Morgan Chase was trying to get the Saudi IPO, which is that J.P. Morgan Chase in the U.S. has canceled personal banking accounts from people who said things that they didn't agree with. And so, okay, so listen, I'm on the Bush China Foundation board. I don't have a problem with people doing business in China. Like, I don't have a problem with that. What I have is the hypocrisy of pretending that you care about one thing here and then going and work with people who stand against that very thing.
Exactly.
And so to me, that's the issue. The first issue. The second issue is, and I don't want to spend a ton of time on the Fed, but the banks and the Fed are tied up together in this. And so that's not going to be separated anytime soon. But the banks are basically our big banks. If you look at them in the Federal Reserve, there's a lot of overlap there. They get low interest rates from the Fed, and so there's that problem as well. So with all my libertarian ideology.
That's a good argument. I didn't think of that. That's a really good argument that they have access to it. Like, how can they do this? They're getting this from the Fed.
Getting it from the Fed, right? And so
Yeah.
it's like, you know, if you're using, if you're using our money essentially, which is what it is, then should you be able to even make these determinations? Which is an interesting question.
And that's a really good point. I was thinking about it more, when I wrote this, I was thinking about it more along the lines of like, these industries are legal in the United States. If the government comprised of elected people, like people that we elect, wants to decide to make these industries illegal, then at least like we as the people are at least somewhat having a say, and there'll be debate on it, and like we can decide like we don't want to make, this is no longer a legal industry, just like we have debates over marijuana, right? And whether or not that's can be considered legal, and we have these debates, and people vote on these propositions and all sorts of things. So it's not a bank's decision to decide whether something is like a moral industry or not. That's the people's decision. And you make a really good point by saying, yeah, and they're also using our money.
Right. They're using
basically giving them our money.
We're giving them our money. And so I would say to the banks that if you want to choose who you serve and don't serve, then just don't take Fed dollars. Like, separate yourself fully from the Fed. And then if you don't want to serve oil and gas companies or marijuana dispensers or whatever, then okay, you're operating autonomously. That's how a business.
Yeah.
I'm fine with the business making decisions. And this is always, when you talk about these arguments, it's so frustrating because we've intertwined government, America, democracy, and capitalism. We've intertwined government and for enterprise so much that it's hard to make these distinctions now. And so, to your point, under the current system, what you're proposing makes the most sense, because under the system you can't actually separate government and private banks at this point, and that's what's frustrating. So if you want to be a private bank and you don't want to loan to oil and gas, that's fine. Just don't take the Fed dollars, because
that's a really good point. Yeah. So. That's like what they say with universities. So like they get funding, and there's like they're saying there's some universities that don't take any funding. Like I think like Liberty University, and so they can do like they don't have to abide by the government or the Department of Education standards and stuff.
Right.
Yeah.
Thank you, Joe.
Point. I wish I'd run this by you before I published it, because this is a really good point.
So that will be my point in the War Room newsletter. So you don't have to read it now.
Okay. Well, everyone should go and sign up for the War Room newsletter to see more of Ryan's brilliant analysis on the subject, because
I don't know about that. I have blind hog or something like that. But okay. So let's see. We got Dr. Foreman coming on live within 2 minutes. So I don't want to get too far into anything else.
We could just say it's really cold in Japan, and they're having trouble keeping their lights on with the power grid.
Yes, it is cold in Japan, and that's it. And so I see Dr. Foreman is there, so we are going to bring him on live, which is it's
a little drum roll.
So he can't hear us. We can see him, so we're going to bring him on and hope everything goes smoothly. It's the first time we've done a 3-person stream. So, and Dr. Foreman, either you are live and can hear us or not. Let's see, how does it go?
Happy New Year. Hopefully you can help.
Hey! Yay!
Okay,
All
works. Good.
There we go. Happy New Year to you, sir. How's it going?
Going well. Yeah, fast start to the year here.
Oh, I hope you had your coffee, because it's just going to keep going.
Yeah, I've had a few of those monster drinks, yeah.
Dr. Foreman, let me ask you, because I asked you before, can we show the report on our live stream, or is that kosher, not kosher? It's fine either way for me. You just tell me. We can hold off if we need to.
Let's hold off since it's not vetted. Okay. I think we can talk about it just fine.
Okay. We'll talk about it. We'll leave it off. So this has not been published. It comes out on the 14th. You can go to api.org. At the top right, Chief Economist is where you can find this report that I'm seeing right now. Because Ellen and I are the elite, we get access to stuff like that. Okay. Let's go to the executive summary, where we start. So often in December 2020, U.S. oil markets achieved 2 milestones despite a year of severe challenges: record high refining and petrochemical demand. The U.S. was on a path, was a petroleum net exporter on an annual basis for the first time in more than 60 years. So record high refining, and a net exporter. Which of those two shocked you the most, Dr. Foreman?
Well, I think we saw a mile coming, the export piece, because we've been monitoring that over the course of the year. The thing that's remarkable really is that in a month when, from a transportation fuel demand, you're actually down because you had the major holidays falling on weekdays, which really disrupts some things if you're doing year-on-year comparisons. But for the refining and petrochemical sector to take off with more than 10% year-on-year growth, despite that, is pretty phenomenal. So that is surprising.
Yeah, and let's see here. Let's pull up the other thing that we like to talk about a lot is the API economic indicator. We're not back to where we were, but the economic indicator, things are looking good. No, I know you are the doctor and I'm the dummy. I'm a little bit pessimistic, but I see your indicator that gives me some hope. So that is good news.
Well, thank you. The way this thing's calibrated, API's DEI, or Diesel Economic Indicator, is calibrated so that it pretty much matches with the year-on-year change in industrial production for the United States. And it's continued to increase with basically smaller negative numbers, saying that from a month-to-month standpoint, industrial production's been going up, right? It's just that, as you said, it's still below year-ago levels. So not surprising, but the amount of progress and, frankly, off of the bounce from the second quarter, it's pretty phenomenal, the amount of recovery that we've had.
One other real quick, and let Ellen hop in here. We've covered a few stories about diesel usage in China and stuff like that. Have you seen that trickle into some of the numbers y'all recording? Because some of the reports out of China is, hey, the diesel usage is up. I think India as well. Has that impacted any of the numbers that you've seen here in the U.S.?
No, it really does. I mean, I guess through on the margin through the trade balance for some of these products, but for the most part, what we're monitoring and what we're seeing is really just fundamental activity in the United States having some recovery.
I was wondering if you could weigh in on something interesting that I observed, which was we're still going really strong with the naphtha and the gas oil demand. We're seeing record high refining and petrochemical demand for naphtha and gas oil, and yet not so much in the other areas. What does that tell us about where the market is right now and the economy is right now?
Well, the fact that we had several months of really improving demand on the transportation side, and then some backsliding in December, which I think really is the seasonality of having less driving in transportation due to COVID-19 and the holidays falling on weekdays, which otherwise disrupt some of the necessary commuting activity that goes on across the United States. Now, on the petrochemical side, you've got changes, a lot of sterile packaging, medical plastics, antimicrobial coatings, including polymers. I mean, you've got a lot of things that have really ramped up and been absolutely essential and crucial through COVID-19. And that, with naphtha, gas oil reflecting the activity in refining and petrochemicals, really is the bright spot.
Very interesting that we're actually seeing this in the numbers right now. I mean, I remember when maybe I probably mentioned this last month, but when I was seeing the news reports of the vaccines being delivered, and all I could see everywhere was plastic, and coolant and refrigerant, and and the oil needed to transport it. And it's interesting that we're seeing that in the in the data right now and in these numbers in terms of petrochemicals. It's also interesting that we're seeing it in the United States. It's not like we're necessarily sourcing this stuff from elsewhere. Do you think that we could also become, that our exports of these products, or at least of the derivatives needed to then create these products, could that be going somewhere?
It's certainly helped, and we've seen some buoyancy in the exports of plastics and related derivatives and products. And then we have all the alcohols and glycols and other things that have been essential too through COVID-19. So that, you'd expect some rebalancing, right? As the economy recovers, as vaccines roll out, hopefully some of that, out of the necessity of it, backslides a little bit, but then you have the compensating increase in people going back to work, transportation, all of that activity that is good for the industry.
Let me ask you about the imports, and we probably discussed this last year, but looking at the chart now that we have, we can go back a full year, and so if you go back to January and February last year, it looks like how our imports were acting then. We're kind of outside of the norm then. We would expect the imports to go really up and to the right now. They're not. So this got to take out the middle of the year. Had something already changed in the first quarter of last year, so we should expect the imports to look different moving forward?
Well, I think there are a few things, and you have to start talking about the quality of crude oil in the United States and what's going into refining, right? The quality, yeah, light versus heavy in particular. And we've been limited for a few years in trying to get more heavy oil out of places like Venezuela, which has dropped off the map. And Canada has produced more, but the ability to get more via pipeline has really been limited. So if you're going to rail that or do other things, it adds even more cost. And then you had Alberta back at the end of 2018 start to impose restrictions on the amount that could be produced. And that had a price impact for a short period. It backslid for a while, but net, the impact has been now, if you look at the light heavy differential, price difference between, say, Western Canadian Select crude oil and West Texas Intermediate, a light sweet crude oil here in the United States, that it's ranged where it, with that production limitation, had gone sub $10 difference, with WTI being at a premium to the heavy crude oil. Then through the worst part of COVID-19, this backslid and it was closer to $20, $25 a barrel. And now it's back down in that 10, 11 range where effectively, if you get to that point, you've got certain refiners locationally advantaged that want that. They've got crackers and cokers. They need that heavy oil. They'll run it if they can get it. But there are economic limits as to how much they'll pay before they'll cross over to something. And what we've really seen over this last year is refiners taking much more advantage of the light sweet crude oil that we're producing here at home. The percentage of light versus heavy has really shifted, and it's cost. These policies, well before COVID-19, have kind of baked in some lost market share for Canada as a result, and that really limits their prospective growth as producers going forward. At the same time, the U.S. being able to take advantage of this, and Ryan, the slide you were making reference to, or the point you were making reference to, we've got really the lowest crude oil imports as the U.S. in almost 30 years here. So it is a structural shift, and we'll see how it plays out as the economy normalizes.
Yeah, one of the things that I remember I was on a TV show last week, and they brought up the fact that the EIA data showed that in the previous week, the U.S. had imported no barrels from Saudi Arabia, and that this was a huge thing. I thought it was more interesting that they'd also imported no barrels from Iraq and Nigeria, which were the other really big, OPEC producers. So it wasn't just a Saudi thing, but is that maybe perhaps a factor both of our refineries finally being able to take better advantage of the oil that we have at home, or is it more Saudi Arabia just concentrating on sending its oil to Asia, and they're really just not that interested in the U.S. market at the moment?
It's a little bit of both. I mean, we really have taken advantage more so of domestic crude oil. Saudi Arabia, if they want, and we saw this really back in the March, April, early April timeframe when OPEC and Saudi versus Russia really triggered a price war, right? At that time, Saudi Arabia was aggressively discounting its official selling prices to gain some market share back in the U.S. A month later, a lot of these cargoes arrived, and we were swamped.
I remember the flotilla of oil, Saudi oil, is coming to Texas. Yes, yeah. Well, and that was part of the point that I made, which was that if Saudi Arabia wanted to flood the U.S. with oil, it could. It could decide to do that if it really wanted to, and there wouldn't be, as it did. But if the market conditions are such, it would rather send it to Asia.
Well, they're kind of mindful of not doing that for a reason, and it's because in the past there's been litigation and accusations that they've been dumping crude oil if they do that. So they're really mindful of generally not trying to aggressively discount into the U.S. And keep in mind, this is also, barrels are fungible around the world, right? So every barrel that they place here is a barrel that, if world demand is held constant, doesn't get sold somewhere else. So they're going to smartly seek the better margins in the near term, as well as the long-term customer relationships, especially into Asia Pacific, that really help them strategically in the long run.
So let's talk about kerosene jet fuel deliveries. One thing I love about the charts is there's a lot of lines now, because I like the 5-year range. But if you look at that one, if you start back about August, the pattern for the 2020 is similar to 2019. It's a little bit more exaggerated. The movement's a little bit more than what you've seen to kind of use that 5-year range number, but it's kind of following the same pattern. I mean, I don't know if we're back to. I don't know if we're at the new normal of deliveries, right? But it looks like it's at least following historical patterns now, where some of these other charts are kind of just still all over the place. Any guess on how close we are to maybe understanding where the jet fuel deliveries are now, or this new pattern, if you will, the new normal?
Jet fuel is the best example of something that's really not back in equilibrium, if you will, as a result of COVID-19. And until we have a lot of vaccinations, there's going to be some hesitancy by consumers to really get on a flight and go. Business travel, we'll see how much of it is structural and remains once people get back in the workplace and there's a resumption of business travel. But that too, and international travel have been disrupted. So to celebrate, for example, in December that you were only down by almost 32% year on year for U.S. jet fuel. I mean, that's abysmal, right? But it's a lot better than the 40% it was down the month before and the 50% a couple of months before that. So when you had several months, where you're talking 40 and 50% down, to have jumped 10% year on year in 1 month is actually quite a bit of progress. But we'll see. I mean, it has a long way to go. And from a refining side, if you're not making jet fuel, you can deconvert that and make more distillate. And since diesel fuel has continued to be in demand, both on the transport side and the industrial side, that's the better market right now.
I know we haven't talked about the 737 MAX in quite a long time. I know it did get FDA approval, and then tragically, like 3 weeks later, Boeing had a plane crash in India. And so, what did that? I know we have all these other things that impact air travel. Might we see some more regulatory stuff coming on the airline industry that could impact flights, or do we feel like they've kind of worked this out and we have an isolated incident I think it was India, the plane crash, was it Saturday? Indonesia, sorry.
It was Indonesia, yeah. And it was, the FAA has gone through a lot of hoops with trying to do this right and really take their time. This has been, they've had the plane grounded for a really long time. They really went through the software. They vetted it the right way. And I think they negotiated and communicated well with their European and other counterparts to try to make sure that this was safe and going back into the air. So I suspect that will work itself out because it's been vetted from so many different angles and from so many different national viewpoints on it. This, the demand in COVID-19 for jet fuel and flying is really the primary thing here. Mm-hmm. And as that comes back, you'd expect the fuel demand to come back as well.
Right. Dr. Walt?
Yeah, I mean, I think the jet fuel issue is definitely one that we need to be concerned about. Do you see any issues in terms of the coming, or it seems to be at least, that there's going to be a potential polar vortex coming for the Midwest this year?
Hey, it snowed in Texas this weekend. So
I saw that. Yeah.
Snowed in Texas. It did not snow here. I think, saw flurries in all the years I've lived here. But anyway, so polar vortex is apparently coming from the Midwest, and I've heard that the temperatures in New York, which of course is the center of the universe, are supposed to be like 5 degrees below average for February, possibly even more. Could that impact? Could we see that showing up in energy prices anytime soon?
Well, it's the old joke about eyewitness weather, right? You look out the window and what eyewitness? And if you have a polar vortex and inventories of heating fuels, natural gas being drawn down, that does tend to influence the market when the market is sitting in cold weather. But
so you're saying it depends. It depends whether the traders are cold.
This is anecdotal, but it does seem to have some correlation with people reminded, in real life that there actually is demand for this heating oil, natural gas, all of it. So as that plays out, there is some impact on it, but that wouldn't be the major thing. Ultimately, people go back to the fundamentals on what are the inventory levels, how much is being produced. And right now they're looking at the production trends and the drilling trends. And that's where, people read the tea leaves on whether the investment environment for the industry really changes this next year.
Yeah, exactly. I mean, it's interesting because we have seen natural gas prices, liquefied natural gas prices, going up a lot in Asia. And seeing as the U.S. is now an exporter of liquefied natural gas, potentially we may see some. I don't think that will affect natural gas prices in the U.S., but it could be a boon for some of these companies who are who are doing that kind of work. It's interesting because I remember back in, I think it was like 2016, when there was the cold snap in New England, and they had horrible bottlenecks trying to get natural gas there. I'm just not sure that they have those problems in the Midwest, those kinds of pipeline issues.
No, they really shouldn't. But I think you're right to highlight just how remarkable the change is on the liquefied natural gas side. And just to put this in context, back in the summer, we saw a point where we basically had $2 million BTU gas, not only in the United States, but around the world. We're just awash in LNG relative to the demand that was there. Fast forward to now, and what you've got are $10, $11 prices in many parts of the world. In fact, you had spot cargoes going to South Korea, for example, one in particular, over $20 per million BTU. So granted, there are market dynamics around this, but basically the demand has really resumed. It's a healthy sign for the economy. It's a healthy sign for the resumption and growth in liquefied natural gas markets. The U.S. as an exporter of this, if you take EIA's latest short-term energy outlook, they've got the exports, both pipeline gas to Mexico and LNG going out of the U.S. continuing to grow this year at a healthy clip. But because we've got domestic gas prices back, roughly in EIA's estimation, it'll average $3 per million BTU over 2021. At that level, it pretty much works for most of the producing basins from a dry gas standpoint to be able to drill more. And then on the demand side, if you've got $10 plus Asian LNG prices, your net back, your ability to convert it and have margin through the value chain really is there, and that works really well at that point. So the international side continues to grow. The domestic side looks like it's working. The only negative to that is in EIA's assessment at $3 gas, you back out about 5 billion cubic feet per day of gas that this last year had gone into this record penetration into the electricity generation sector. So there'll be some trade-offs there about where the gas actually lands, but net, this is a recalibration of natural gas markets across the United States and North America, really, that's continuing to help the market.
That's a very interesting thing to consider, especially when, we like to, I think we often talk about, the frackers as just a bunch of oil companies in Texas, and it's not. It's a lot more diverse than that. So it's important to think about natural gas prices as well.
I know we're up to the clock, Dr. Foreman. One last question for you. Summarize for us holiday demand, holiday travel numbers. Now that I think we've got most, if not all, the numbers from Thanksgiving, from Christmas. I don't know if we have the New Year's numbers in, but how would you, or would you feel, not maybe the year-over-year margin number, but generally speaking, going into it, maybe what did you think we would see? Now that you've seen the numbers, are they better than you thought they would be? Worse than you thought they'd be? Just from a practical standpoint, how do you feel about the travel data that you've seen from Thanksgiving, Christmas, and New Year?
So let's take the last two monthly reports or monthly statistical reports from API. The November data with Thanksgiving really showed a degree of normalcy. I mean, we're back in the 5-year range from a demand perspective, and many of our primary or major refined products were down single digits year on year. December, the numbers, if you just looked at it, were down, gasoline was down 12.6% year on year. That's not great. Distillate, 10.4% year on year down. So you're back basically to the cusp of double digits there. And the seasonality matters, though. You can't even just compare one year to the next because you've got both the holidays falling on weekdays. And that really does disrupt vacation plans, commercial plans, industrial activity, all of it through the value chain. So I would take the demand side for December with a grain of salt. And I think this fact that we've had several months where we've really crawled back into that 5-year range, through November, as a bright spot going into 2021. And if we continue to make progress on the economic side, get the vaccines, have this continued normalization, it's a pretty good stepping stone for the year.
Okay. Anything that you wanted to point out that Ellen and I did not bring up about the statistical report for this month?
I think we've covered the gist of it. Just if people want to go to api.org in the Chief Economist section, we have our monthly statistical report, and we also have our quarterly presentation, which is API Industry Outlook. So all of the key themes covering the global economy, oil markets, and gas markets.
Okay. Well, Dr. Foreman, thank you so much. We will have you on again about a month from today, roughly around, I know you sent over your schedule. I don't have it in front of me, the 8th to 15th, somewhere in there. We'll have you back on to talk about what's going on in February. Hopefully, the news cycle will slow down a little bit between now and then. It was good to talk to you, and hope you had a wonderful holiday season.
Thank you so much. Great seeing you, and I look forward to it next month.
Thank you, sir.
Thank you.
And once again, that is Dr. Dean Foreman with the American Petroleum Institute. You go to api.org to check out all of they have. They have more than just this report. And as you mentioned, the top right of the screen, chief economist, Dr. Wald. You did get someone who is wishing for snow in North Florida. So there you go.
Yeah.
One fan. We got, I think it was 4 or 5 inches here yesterday. Oh yeah,
That's a lot.
it was nice. It wasn't really sticking. So as soon as it stopped, it didn't melt all the way. There's still some out there, but it started kind of melting. But enough for us to have fun and play with our friends and all that stuff and kids and stuff while fighting. So it's good. Okay, so Dr. Wald.
That's a good one. I like that.
Where will you be this week? Not Forbes.
Yeah, I will not be on Forbes anymore. I've decided not to write for Forbes anymore, and you can view my opinion on that on my Twitter page if you so desire. I'm not going to make a big deal out of it here. But you can definitely find me on investing.com, where I have a weekly column comes out Thursday morning about the oil market and all things of that sort. And you should check out my latest piece on Barron's. We discussed it on the show about some of the financial effects and kind of the meaning for investors of this debanking. But I also had a piece come out on The Hill recently that looks at some of the policy impacts and what we could potentially see for oil companies and even some national security effects there. So check it out.
Yes, we did not cover much of Japan because
next week.
Maybe next week. Limited time. Sorry. So apologies for Japan and all of the other stories that we didn't get to. Okay. Warroomnewsletter.com, warroommedia.com, whatever. I'll be there. Text on Guys Podcast. I'll be back on this stream here in about an hour. Also, I have a show I do with Chris Fenton called Feeding the Dragon, talking about U.S. China news. And so that podcast right now. Yeah. So
there's a lot to get into there.
Yeah, well, I was pretty excited to see what Pompeo did with Taiwan. I guess it was last night, so that was pretty exciting. So, okay, all right. Well, we will be back here live now that Dr. Foreman's live with us, which we had to work out. Thank you for the API for working that out. They had to stuff, so thank you guys for working that. We'll be back live again next week. Until then, hope everyone stays safe. And I will leave you with this thought: if you are depressed and you are frustrated, just know. Let's see. I want to quote this properly. That Andrew Cuomo came out today and said, "We simply cannot stay closed until the vaccine hits critical mass. The cost is too high. We will have nothing left to open. We must reopen the economy. We must do it smartly and safely." So, if you were depressed, Cuomo.
See, that just makes me more sad because, where was he in April? That needed to be said in April. Go support a small business. That's what I'll say. Just, I don't know, go buy a cup of coffee from a small business. I hope they're open and serving coffee in some form.
We will end on that. Go buy a cup of coffee from a small business. Talk to you next week.